managerial accounting, the contribution margin income statement. Now that we've separated mixed costs, all of our costs, into their fixed and variable components, then there is an alternative way of looking at the income statement that will help managers to be able to see how various changes in activity in production and sales will impact the profit. Now, the traditional income statement, which is sales minus cost of goods sold equals gross margin, minus selling and administrative expenses equals net operating income, has its value for external purposes, but it's not really helpful to managers when they want to see how selling 500 more units will impact profits. In order to see that, we need to separate that income statement according to cost behavior. So the basic format of this new statement, the contribution margin income statement, we still start in the same place, our sales revenue. But instead of subtracting just cost of goods sold, from sales revenue we subtract all variable costs. That would be variable cost of goods sold for a retailer, as well as variable selling expenses like sales commissions, and variable administrative expenses, whatever those might be. So all variable costs are subtracted from sales. And the difference between sales and variable costs is called contribution margin. Now, in addition to being mathematically being the difference between sales and all variable costs, contribution margin also tells us the amount that each additional unit sold contributes towards covering the next cost, which is fixed costs, and once fixed costs are covered, providing a profit. So that's how the remainder of this statement fleshes out. From contribution margin, we subtract out all fixed costs. And again, that could be fixed production costs like depreciation or rent. It can be fixed selling costs like fixed advertising, or fixed administrative costs like the president's salary. All fixed costs have to be covered before we can have a profit. So contribution margin minus all fixed costs yields operating income, or if those fixed costs haven't been covered yet, operating loss. Now let's just put some simple numbers in here so we can kind of flesh out this income statement. All right, first of all, I need to shift this over. There we go. Let's say we're going to keep up on this contribution margin income statement with information about the totals and per unit information. So let's say that our sales price per unit is $20, and that this period we sold 25 units. So $20 price per unit times the $25 units rather, that's going to give us total sales revenue of $500. Now, let's also say that all of our variable costs, production, selling, administrative, whatever, all of our variable costs add up to $5 per unit. Okay, $5 per unit. So our contribution margin per unit, $20 sales price, minus $5 variable cost per unit, our contribution margin per unit is $15. And that's where we're going to stop with the per unit information. But we need to continue filling out the total information on this income statement. So back to our variable cost, $5 per unit, and remember we sold 25 units, so 5 times 25, that's going to be a total variable cost of $125. And 500 minus 125 is going to give us a contribution margin of 375. Now remember, contribution margin is not only sales minus variable cost, but it's also the portion of each sales dollar, in this case each unit sold, that contributes towards covering first fixed costs and then providing a profit. So filling out the income statement, we got 307 in contribution margin. Let's say that our total fixed costs are $500. So this company's in not good situation. We got contribution margin of 375 at 25 units sold, but our fixed costs total 500. So at this sales volume, we have not yet covered all of our fixed costs. And if we haven't covered our fixed costs, then we do not have a profit, rather we have a loss. And in this case, our loss is $125. So that's the basic format of the contribution margin income statement. And notice what it tells us. It tells us that for each unit sold, we add $15 first to cover the $500 of fixed cost, and then to provide a profit once the fixed costs are covered. So the next question this business is going to ask, 25 units isn't doing it. How many units do we need to sell in order to move from a loss to a profit situation?